Welcome back, everyone, to the GMS Weekly Podcast, your quick and candid roundup of the global ship recycling market. Brought to you by GMS, the world's largest buyer of ships and offshore assets for recycling. This is week 48 of 2025, and the headline says it all: stumped yet primed. And honestly, that is exactly how the market feels right now. Confused by fundamentals, but strangely hopeful for what is coming next.
Absolutely. After Thanksgiving, the global market behaved like someone who went back for one too many servings. Messy, unstable, and slightly regretful. Steel prices across the entire subcontinent and even China all fell this week, every single location moving down together. At the same time, the US dollar weakened in nearly all subcontinent markets except Turkey, where the lira continued to slide with no signs of stopping.
So let us set the stage. The Baltic Dry Index climbed another 3.2% this week, reaching its highest level since December 2023. Freight remains firm across almost all segments. Oil, meanwhile, continues to idle at 21st century lows, closing the week at about $59 per ton, roughly 14% down compared to this time last year.
And supply still painfully thin. Sanctions, blacklists, and strong freight earnings continue to restrict recycling candidates. Most of the tonnage entering the market is either off-market, questionably sourced, or smaller lightweight units that trade well below $400 per lightweight ton. Good, clean, larger units can still achieve a price above $400 in certain locations, but those opportunities are becoming fewer and fewer.
But there was one major positive this week, and it came out of Pakistan. Pakistan has officially entered the HKC era. Prime Green Recyclers in Gadani became the first ever Pakistani yard to receive Hong Kong Convention certification, awarded by Bureau Veritas. This is a milestone moment for the country and for the broader market. More Pakistani yards are already going through the upgrade process, and the next round of approvals is expected in about 3 to 4 months.
Economically, though, things remain fragile. Steel plates in Pakistan fell by about $7 this week, ending near $579 per ton, while the Pakistani rupee firmed slightly to roughly 282 to the dollar. And once again, the Gadani anchorage reported no new arrivals. Not a single vessel was listed in the port position this week. Even so, Pakistan still holds second place in pricing, with indications of about $400 per lightweight ton for bulkers, $420 for tankers, and $430 for containers.
Now to Bangladesh, which once again leads the subcontinent in pricing, even though the market there remains fragile. 21 yards are already HKC approved, and a 22nd yard is essentially ready to join the list. The challenge, however, is the same one that has persisted for 4 years: a severe shortage of supply. Some recyclers are beginning to question whether these significant upgrade investments will pay off while tonnage remains scarce.
Steel plates in Bangladesh fell again this week, dropping another $11 to reach about $506 per ton. The taka, on the other hand, strengthened slightly, ending the week around 122.08. Political tensions remain elevated as the interim government manages scattered unrest ahead of the February 2026 elections. But the good news is that Chattogram did see activity. Several small units arrived, including LPG carriers, a bulker, and a chemical tanker. The port position shows a total of 5 vessels and more than 22,000 lightweight tons of arrivals this week.
Pricing in Bangladesh remains the strongest in the region, with indications around $410 for bulkers, $430 for tankers, and $440 for containers. Most competitive, yes, but that does not mean the market is comfortable.
Moving to India, another subdued week for Alang, where most tonnage still struggles to cross the $400 mark. This keeps India out of the running for many competitive vessels. Even Hong Kong Convention tonnage is slipping away as Bangladesh expands its compliant capacity, and Pakistan enters the arena with its first approved yard. All of this is happening despite India's overall economic strength, including a strong GDP reading of 8.2%, driven by construction and manufacturing.
Steel prices in India dropped another $5 this week, ending near $390 per ton. The rupee also saw a slight improvement, finishing the week around 89.35 to the dollar. Pricing levels remain about $380 for bulkers, $400 for tankers, and $410 for containers. And yes, a few questionable tankers still found their way into Alang, as usual.
And finally, Turkey. The lira continued its decline this week, falling past 42.50 against the dollar. Inflation is hovering near 33%, although GDP still managed nearly 5% growth in the second quarter. Recycling activity in Aliaga remains quiet, with prices steady around $260 for bulkers, $270 for tankers, and $280 for containers.
So, where does that leave us? Steel prices are down across all major markets.
The US dollar is weaker in most regions.
Freight earnings remain strong.
Supply is still extremely restricted.
And HKC compliance is rapidly expanding, now present in all three major subcontinent markets.
Despite all the turbulence, there is a sense that momentum is building again, especially with Pakistan joining the HKC club and Bangladesh pushing ahead with its compliance expansion. We are 4 weeks away from the end of the year, and the industry is still hoping that 2026 will finally bring the long-awaited market revival.
For full analysis, steel charts, port positions, and all market tables, be sure to download the complete GMS Weekly on the GMS mobile app. Thanks for listening. Stay safe, stay sharp, and as always, stay anchored with GMS, the world's largest buyer of ships and offshore assets for recycling.